Satisfying your cravings has never been easier with the rise of fast food chains through the years. Whether it's pizzas, burgers, nachos, or chicken nuggets, you'll certainly have someplace you'd easily get them from. One of which is the national fast food chain, Burger King, which offers a variety of flame-broiled burgers at affordable prices. The restaurant generated over $1.78 billion in revenue from more than 18,000 franchised units in 100 countries worldwide, making them one of the most valuable global quick-service brands. The fast food chain's growth, along with its predictable revenue stream, urged Bill Ackman, CEO and founder of Pershing Square Capital Management, to invest in the company under a complex deal he made with two other investors. Before we dive into the acquisition of the 29% stake, let's first take a look at Burger King through the years. Before Burger King became the restaurant we know today, it went through a series of owners and corporate governance changes. In 1953, the chain initially started as a Florida restaurant named Burger King, after a special grill machine called Instabroiler. The founders, Keith Kramer and Matthew Burns, were inspired to venture into the restaurant business because of a nearby McDonald's, the fast food chain which would later become their toughest rival. After a year, Cornell University classmates James W. McLemore and David Edgerton purchased an Burger King Miami franchise from the Kramer-Burns duo, and the business grew with the introduction of their signature product, the Whopper, in 1957. While the McLemore-Edgerton franchise was doing well, Kramer-Burns wasn't. The original company suffered through a financial crisis which forced Kramer and Burns to sell the chain to their Miami franchisees. With McLemore and Edgerton leading the company, they began to restructure its operations and branding, changing Burger King to Burger King in 1959. The new leadership allowed the Florida restaurants to become a national chain in 1961. They were also able to expand outside the continental U.S. 2 years later. Despite the progressive growth of the company as the second-largest burger chain, Burger King didn't manage to pull ahead of McDonald's sales and profitability. The McLemore-Edgerton leadership ended in 1967, as the food-producing company, Pillsbury Company, purchased Burger King for $18 million. Their acquisition initiated the golden age of the franchise when they hired former McDonald's executive Donald N. Smith in 1978. Smith's attack on the company's structure involved the reconstruction of franchise agreements and broadening of the menu. He imposed that franchisees must not have other fast food chain franchises and must be an hour drive away from their unit. Not only did he encourage loyalty among the franchisees, but also a more active participation on the part of these owners. Smith controlled an increase in sales by 15% in 1980. Unfortunately, he left the company after being given an opportunity by beverage giant PepsiCo. His departure resulted in a system-wide decline in sales, which forced Pillsbury to assign the strengthening of the brand to another person. Norman Brinker, Vice President of Restaurant Operations, launched a controversial ad campaign which involved Burger King claiming their burgers were bigger and better than that of McDonald's. The promotional campaign, coined as the Burger Wars, was probably the first ever political attack ad in the food industry, and things resulted in multiple lawsuits for Burger King. The bright side, however, is that the controversy boosted sales for the burger chain. When Brinker left in 1984, Burger King went through a series of financial slumps. The chain's underperformance led Pillsbury to sell the brand to entertainment conglomerate Grand Metropolitan in 1989. Under the new management, Burger King changed its distribution system, partnered with Walt Disney Company, and expanded internationally. Those weren't the only changes Grand Metropolitan employed. In 1997, Burger King merged with Irish brewing giant Guinness plc and formed Diageo plc. The move proved to be a horrible one, as Diageo neglected Burger King's branding, causing its value to plummet and forcing its sale years later. Private equity financiers, Texas Pacific Group Capital, Bain Capital, and Goldman Sachs Capital Partners purchased the fast food chain for $1.5 billion in 2002. Like any other takeovers, the new owners employed their own strategies such as revamping individual stores, and introducing new ad campaigns. By 2006, Burger King filed for an initial public offering, IPO, wherein it generated $425 million in equity. While the owners were able to bring the franchise around, they were hit with a financial crisis and were left behind by McDonald's, leading the investors to sell the company a few years later. In 2010, Burger King was pulled off from the public market when the investment firm 3G Capital acquired the fast food chain for $3.26 billion through a leveraged buyout, $1.56 billion of which paid in cash. The hefty price tag yielded its exiting investors a five-fold gain, which made analysts wonder how 3G Capital was planning to get their money back. The firm initiated control by restructuring the chain's ad campaigns, reformulating products, introducing new meals, and improving their packaging. In just a year, 3G Capital increased Burger King's earnings before interest, taxes, depreciation, and amortization, or EBITDA, minus capital expenditures by nearly 60%. However, this wasn't enough to compete with McDonald's and Wendy's, who took the top two spots as the largest fast food chains in the US. While Burger King fell short in rankings, the firm's strategies brought in growth for the company, even capturing the eyes of big investors. Burger King came back to the public market in April 2012. However, the chain's return didn't come with an IPO, but a deal with the special purpose acquisition company Justice Holdings. This was formed with the specific purpose of acquiring another company in February 2011 by Bill Ackman of Pershing Square, Martin Franklin of Jarden, and Nicholas Berggruen of Berggruen Holdings. In this case, the company was Burger King. Justice Holdings purchased a 29% minority stake of the restaurant for $1.4 billion, while 3G Capital kept the remaining 71% and remained in control of the brand. By September of that year, news regarding Ackman's passive stake surfaced. His company owns about 10.9% of Burger King, while he held a 1% personal stake. The news led to a 3% increase in shares of the chain. What made Ackman buy roughly 12% of the restaurant is its improving financials and management under 3G Capital. To add, Burger King's predictable revenue and great free cash flow were also key reasons behind the huge investment. Fortunately, Ackman's bet on the chain bore fruit when he made $203 million in August 2014. During that year, Burger King also sold 8.4 million shares to Warren Buffett's Berkshire Hathaway after the investor offered to finance $3 billion for Burger King's $12.5 billion merger with Canadian restaurant chain Tim Hortons. The acquisition resulted in the fast food holding company Restaurant Brands International. Ackman's win on the restaurant business continued in 2017, with Burger King making more than $14 billion for its stakeholders. After adding 1 million more shares from the previous year, Ackman's stake was worth $2.5 billion then, $220 million of which were from his personal stake. The number nearly quadrupled Ackman's initial investment, which sets his Burger King investment as one of his greatest hits. With Burger King's significant growth, Restaurant Brands decided to purchase Popeye's Louisiana Kitchen for $1.8 billion. This was then added to the roster of subsidiary fast food chains under Restaurant Brands. The company's expansion was running up stock prices and becoming too much for Ackman's company to handle. This forced Pershing Square, the largest stakeholder, to sell 10 million of his QSR shares through a block trade. Basically, a block trade is when a party sells a significant number of shares to another party. Such high-volume trades, however, can cause large fluctuations in the market value of shares in the open market. In Ackman's case, selling QSR shares worth roughly $610 million worth resulted in a 2% decline in shares in July 2017. Since then, shares fluctuated within the $50 to $70 margin. Well, that is until the virus outbreak hit the restaurant industry in 2020. If you were keeping a close eye on Ackman's investments, you'd know that he took $27 million worth of portfolio protection to save his holdings from the impending drops due to the outbreak. This operates similar to insurance, such that if something bad were to happen, the buyer of the contract is paid a considerable sum by the other party. The safety net, however, is riskier than liquidating assets since it doesn't guarantee a return for the buyer. But, obviously, Ackman's risk paid off as drops in the market happened in 2020. QSR even reached a $25 low in March. Given the circumstances, the investor managed to gain roughly $2.5 billion from the credit hedges, some of which were used to significantly increase his QSR holdings. It was the perfect time to buy, considering that share prices were dipping. By May 2020, Ackman held roughly a 9.6% stake of Restaurant Brands, and the company went back to their $50 and $65 per share margin in just a few months. Ackman's bet on Burger King certainly paid off. Not only was his portfolio in the restaurant industry expanding, he has also never lost money in those investments. Such high returns urged him to stay with Burger King and its fellow subsidiaries. Do you think Ackman's passive role in Restaurant Brands contributed to its success? Let us know in the comment section below. And if you're new to the channel, don't forget to leave a like and subscribe.